So now we're going to start with the actual accounting side of accounting. That accounting equation things that we've been doing are theory questions. They're saying to you, if you have this transaction, what are the two accounts? If you have this transaction, how does it affect your assets? If you have, but you're just putting it in a table and you've actually answered a theory question or 5. All right, so now study unit 5. I've just split my slides into 2 sections. So I'll tell you when we get to the B section, just label this section 5A, just so that when you are looking on Google Drive at my slides, you know which are 5A and which are 5B. Okay, so when we get to 5B, I will tell you. All right, so we are going to look at the actual accounting cycle now, literally from where does the accounting process begin and where does it end. When a customer walks into the shop, that is not a transaction. When the customer picks up the item of clothing and actually tries it on in the change rooms or the trying on fitting rooms, that is not a transaction. When does the transaction start? When he comes to the till and says, I want to buy something, and then they put that nice little agreement in some sort of writing by putting it on a till slip or an invoice. If you've got an account, you've got the idea. That is when the transaction happens. It is then recorded on some or other source document. Now, source documents are things like checks, receipts, invoices. Okay? Now, in accounting, we're very organized. We take all our checks and we keep them together in one little pile. All our invoices we've received here, all our invoices we've issued there, and all our little, did I say checks? Receipts in another pile. Anyway, each type of source document will be in their own little pile, and all those source documents will be recorded together. Where they are recorded is called a journal. A journal is like a diary. Similar to your diary, you say on this date, this happened with this person for so much money. And this was what the money was for, accounting for each cent that you receive. And everything that you receive will go into the cash receipts journal. Everything you pay will go into the cash payments journal. Everything you buy, not everything you buy. When you buy stock on credit, it will go into something called the purchases journal. When you sell something on credit, it will go into a sales journal. We'll do the journals later. But those journals will have the date of the transaction, the person you transacted with, and the amount and the 2 accounts that were affected by that transaction. Right, so that's the journal. So each journal will summarize, for example, all the money you've received. And at the end of the month, you will take all the money you've received and you will post it to something called the ledgers. You get the general ledger, debtors ledger, and creditors ledger. And from those ledgers, you will have a bank account, and you'll say, this is money received, this is money paid, and this is what's left. You'll have a debtors account. This is what I've sold to my debtors. This is how much they've paid me. This is what they still owe me. You got the idea? Those accounts will then be balanced so we can see what is the final balance still owing, or what is the balance in my bank account. We'll draw up a little trial balance which lists those accounts with their balances, and we test. That's why it's called a trial. It's a test to see if you followed the double entry principle. And then that happens monthly, and then you start again next month, transactions, source documents, journals, ledger, trial balance, blah, blah, blah. You do this 12 times a year. So times 12 months. And at the end of the year, you're going to do some year-end adjustments because we need to tweak certain things, and then we're going to prepare my financial statements, which I'm going to abbreviate AFS, annual financial statements. And here are the names: the statement of profit or loss and other comprehensive income, not just the income statement, not just the statement of comprehensive income. Anyway, so I'm abbreviating that with a PL. We're going to do the statement of changes in equity, and that's SCE. The statement of financial position, which is FP. So this is an overview of pretty much the entire syllabus for FAC 1503 and 1501s. The 1500s don't even get to the financial statements. So we will get there. So these first few sections here is what we are going to learn in study unit 5. Journals, ledgers, trial balances. The year-end adjustments we will do in study unit 6. And the financial statements we will learn in study unit 15 directly after we've done study unit 6. We also do closing transfers and things like that, but yeah. So the annual financial statements, as the name implies, they are done annually, once a year, usually. Okay, got the big picture? And then we start next year, 12 months worth of the top part of the cycle and one big annual financial statement. And this carries on and on and on. You happy? That's just an overview. Now, while they might not ask you a question like this in the exam, they could, in a multiple choice question, say, here are some activities. Record the transaction in the journal, post to the ledger, prepare the trial balance, put them in the right order. And you'll say, this one's first, that one's second, that one's next. Okay. Now, the reason you prepare your annual financial statements is so that the owners can see, did I make a profit? Do my assets cover my debts? Am I in a strong financial position or not? And then they can make decisions going forward. So what you do with these financial statements is you analyze them and interpret them, which is not part of your syllabus. That's why it's not on here. You analyze and interpret. You do ratios and things like that. And then you make decisions and say, right, should I keep going or should I close? Should I add a new product or should I change something? Got the idea? So often they'll include that in your accounting cycle theory question in an assignment. After you've done your financial statements, first I write it down, you analyze and interpret. Oh, interpret doesn't start with a T, hey? Interpret, and then you make your decisions. So that's the entire process. But this bottom part is actually part of financial management, which you will do in second year when you start with MAC, management accounting. And or even when you're doing financial management. Okay, so that's the accounting cycle. Now, in accounting, we've got two terms that frighten most people that I have mentioned to you in study unit 4, and that's your debits and credits. So tell me something. What does debit mean? Those who've done accounts at school, what do you understand debit to mean? Anybody? Say again? The account that's receiving. This is the only part where I go, no. It's not wrong, but it's not the right answer. Debit is always what? Anybody? On the left-hand side. So credit is the right. It is Latin. Remember I said I didn't know if it was Italian or Latin? I think it's Latin. Old Pacioli, the Italian guy, back in 1811, I think it was, or 1911, but either way, it was a very long time ago. He developed this double entry system. And he said, I am going to give each account, remember we've learned all our accounts, bank account, debtors account, rent income, those accounts. I'm going to draw a T, a line. I'm going to have a account name. I'm going to underline it. Yes? Very hard, hey? And then I'm going to split my page down the middle. Go slowly, don't hurt yourself. And I'm going to call the left side the debit side and the right side the credit side. And the only reason for that is the word debit means left hand or left. And the word credit means right. So can you see them in the army? Debit, credit, debit, credit, debit, credit, halt. It's got nothing to do with accounting. So it's not receiving. Does that make sense now? Okay. Debit, for some funny reason, is abbreviated DR. There's no R in it. If you want to say DT, that's fine. Credit, at least that one makes sense, is abbreviated CR. This means left. That means right. So that's very hard, hey? Label your page, left and right. You are on the debit side of my side of the class, and you're on the credit side of the class. If I turn around, well, then you're the debits and you're the credits. Does that make sense? It's got nothing to do with accounting, so I don't know how scared you are of this debit and credits, like being scared of your left hand. Have you seen those movies where the left hand does its own? No, I'm joking. You got the idea? All right, so now, you're going to hold that thought. You're going to come back to this page, Nana. You're going to turn the page and follow me. I've got a page labeled dead, and on the next page, I've got a page labeled CLIC. So just pay close attention to which page I'm on. So you're going to flip between the two. I'm going to irritate you, but that's okay. Let's look at this double entry. I've said to you, when you do a question, you've got to identify the two accounts and put them under the right categories, and then look at the effect on the accounting equation. So we're just not going to do the accounting equation part. So let's go with, I'm going to make up transactions. The owner contributes 100,000 to the business. What are the two accounts? Bank and capital. On the dead page, write bank. And on the CLIC page, write capital. And abbreviate so that we can get through this quickly and you can actually listen as well. Right, so you're going to have to page fast. All right, now, back to your bank. If I say I want to put money in on the left, then near to the middle, I'm going to write 100,000. I'm going to put a word there. So just leave a space. Eh? What does the double entry principle say? For every transaction, two accounts are affected, bank and capital. For each debit, we need a credit. So if I've got a debit entry, I've got an entry on the left-hand side of one account, the other account must have a credit entry. And again, please leave a space for a word and then put the amount. And I'd like you just to number them so that you know which ones go with which. This is transaction number 1, and that is transaction number 1, just so that you can follow what I did first and second. All right, you happy so far? And now, I want to see the double entry in the bank account. So in the bank account, I want to know that 100,000 on the debit, where does the credit lie? Where does the contra entry lie? Contra means opposite. So if this is the debit entry, where does the opposite entry lie? Where's the credit? In capital. Happy? So let's go to capital and let's do the same there. If this is the credit entry, where does the debit entry lie? In bank. I call it cross-referencing. Okay? Tell me where's the other entry. All right. This is like a cell phone. On my cell phone, I've got calls made to you, and your name is on my cell phone. But on your cell phone, you've got your name on your cell phone. At least it's your cell phone, it's got a name. And calls received will be from me. Please don't phone yourself. So don't write capital in capital. Don't write bank in bank, because you're not going to phone yourself. You got the idea? It's stupid, but it works. All right, let's go another transaction. Let's receive some more money, so I'm going to stay on the same side of bank. So it's like a restaurant with in and outdoors. You can't suddenly change sides in the middle of the night. So let's receive another 50,000 Rand for a loan. So my bank is going to go up. And what's the other account? Just loan. So on the CLIC page, let's go make a loan account. Which side of loan? I've got a debit, so therefore it will go on the credit side of the loan account. That is transaction number 2. What am I going to write in loan? Bank, because the contra entry, the contra account, is bank. And in bank, what am I going to write? Loan. You happy with that? So that you can immediately see, I've received money for capital, I've received money for a loan. It's nice and easy to see. All right, let's go and buy some equipment. So do you agree that money is going out? So it must just be on the other side now. All right, so let's make it 20,000 Rand. So I'm going to take 20,000 Rand out of the bank. What am I buying? Equipment, so I need a bank account and an equipment account. So on this page, put equipment. For every credit, I need a debit. So if my bank is being credited, my equipment must be debited. In equipment, I will write bank, and in bank, I will write equipment. Not bad, eh? Let's go and pay some loan back. So money is going out again. Do you agree? So let's make it 5,000 Rand. Number 4. I'm paying my loan, so the two accounts are bank and loan. I've got a bank account, I've got a loan account. I'm crediting the bank. Money in was on the left, so money out is on the right. What am I going to write next to the 5,000? Loan. So I'm going to go to my loan account. This is the credit, so on the loan account, I'm going to go to the debit side. For every credit, you need a debit. And in loan, I will write bank. So look at your loan account. Can you see when I borrowed money, I put it on the right-hand side, and when I paid the loan back, I put it on the other side? Loan went up, loan went down. Sure, this is like magic, hey? It's a party trick. Party trick for Friday. Oh, it's Friday. Party trick for Friday night. Hey, don't do it, you'll lose all your friends. Can I go on? Let's go and buy some stationery. So money's going to go out again. Let's make it 1,000 Rand. And the two accounts are bank and stationery. So let's stay on the same page. So in bank I write stationery. Which side of stationery do I go? I've got a credit in the bank, so I need a debit in my stationery. Does that make sense? In bank I wrote stationery, so in stationery I will write bank. To debit an account means to write things in the T account, not on top of, inside the T account on the left. To credit means to put something on the right. So if I've credited my bank with a entry on the right-hand side, I will have to debit the other account. Put that entry on the left. Let's go and, what shall I do now? Let's go and render a service. So that means money's going to come in again, right? So let's put 8,000 Rand. I'm going to debit the bank because money's coming in again. This is number 6. And let's, yeah, we're doing it for cash. So what's the other account? Service income. Let's go to the CLIC page. Service income. Right, so what am I going to write in bank? Service income. I've got a debit. Do you see that? In bank, I've got a debit. So in service income, I need a credit. What number is this? 6. In service income, I will write bank with 8,000 Rand on the credit side. And in bank, I wrote service income on the debit side with 8,000 Rand. Happy so far? Let's buy some more equipment. And let's buy that equipment on credit. So I've got an equipment account. What's the other account? Creditors, hey? So let's go to the CLIC page and open a creditors account. And I've already got an equipment account, so let's start with the account I have. I've got more equipment, so I'm buying equipment again, so I'm going to stay on the same side. So if I bought equipment for cash, I put it on the debit. So when I buy equipment on credit, I'm still going to put it on the debit. Let's make it 15,000 Rand. So that's transaction number 7. And in equipment, I'll write creditors. For every debit, I need a credit. So if I've debited equipment, I'm going to credit my creditors. Oh, that even sounds the same. Credit the creditor. Number 7. Is it number 7? Yes. And in creditors, I'll write equipment. You happy with that? You're getting the idea? Okay, let the owner take some money for his own use. Let's give him, how much shall he take? 2 grand. So the 2 accounts are, he's taking money, so bank, and the owner's taking, so drawings. Let's put it at the bottom of this page. Money is going out, 2,000 Rand. In bank, I will write drawings. For every credit, I need a debit. So I'm going to debit, put it on the left-hand side of drawings. And in drawings, I will write bank. So can you see the double entry principle? You pick the 2 accounts. One must be a debit, one must be a credit. It kind of, once you've decided where bank goes, the rest kind of just follow, didn't they? All right, let's quickly go and classify those accounts. Bank is a asset. Can you see it got bigger on the left and smaller on the right? Money came in on the left, money went down on the right. Equipment is also an asset. More equipment, and if I had to sell it, it would go on the other side. Stationery is an expense. More expenses, less expenses. Drawings, just say it's owner's equity for now. More drawings, or don't say anything, sorry, just leave it out, sorry. Drawings, more drawings, less drawings. Isn't drawings the opposite of capital? So on your next page, can you see drawings got bigger on the left, capital gets bigger on the right. They are opposite to each other. Loan is a liability. Can you see the loan got bigger on the right and smaller on the left? Service income is an income. Price. And more income on the right. And if you had to cancel that income, it will be on the left, on the debit side. Creditors are liabilities. They go up here. If I had to pay them, they'll go down on the left. You happy with that? Now the problem comes in is some accounts are getting bigger on the left-hand side and smaller on the right-hand side, and other accounts are getting bigger on the credit side and smaller on the debit. How are you going to remember which accounts get bigger on the left-hand side on the debits and which accounts get bigger with credits. I'm going to teach you two acronyms. So go back to the page we skipped. The two acronyms are DEAD and CLIC. Right. So D stands for debit. The accounts that get bigger on the debit are expenses, assets, and drawings. Debit, expenses, assets, and drawings, dead. And if the D stood for debit, then the C on the other side will stand for credit. If the A was for assets, the L will be for liabilities. So if you know the one, the other one kind of follows. If E was for expenses, the I will be for income. If the D was for drawings, the C will be for capital. Debit, expenses, assets, and drawings. Credit, liabilities, income, and capital. Dead and CLIC. But if you haven't learned those lists, does dead and CLIC help you? If you don't know that stationery is an expense, you've got a problem. If you don't know that a loan is a liability, you've got a problem, don't you? So at the bottom of that page, basically, what dead means is any expenses, assets, and drawings will get bigger on the debit side, which is the left-hand side, and smaller on the credit. CLIC says any liabilities, income, and capital accounts will get bigger on the credit side and smaller on the debit side. Let's go and see if my little example was right. Bank is an asset. Dead or CLIC? Dead. Debit, expenses, assets, and drawings to make them bigger. Debit, expenses, assets, and drawings to make them bigger. And credit them to make them smaller. CLIC says credit, liabilities, income, and capital to make them bigger, and debit them to make them smaller. Does that make sense? All right, so back to that same page, you'll see there's a nice white space there. Another way, or to illustrate a little bit further, let's look at my accounting equation. What is that again? Assets equals equity plus liabilities. Assets equals equity plus liabilities. So if we've got a T account, that T account could be any asset, bank, debtors, equipment. You've learned your assets, non-current or current. You got that here? All those accounts fall under dead. So we are going to debit expenses, assets, and drawings to make them bigger. We're going to debit the asset if we want it to get bigger and credit it if we want it to get smaller. Liabilities falls under CLIC. So we are going to credit liabilities, income, and capital to make them bigger and debit them to make them smaller. Just like I showed you now in the double entry. Your equity is kind of in the middle here. It's a little bit more complicated. Equity consists of quite a lot of things. Let's start with capital. Before we do capital. Equity, the owner's equity generally will get bigger with credits and smaller with debits. What makes the owner's equity increase? Capital and income. Do you agree? And can you see their credits? And what makes the owner's equity go down? Expenses and drawings. Can you see their debits? It's not magic, hey? But it's almost like magic. It's like a party trick. Do you know that magic is not really like voodoo magic? It's actually just a trick of the skill in your hands. You've got to watch somebody closely. You'll see what they're doing. You do know that, hey? Just checking. I'm joking. That's your ad break. Right. So let's look at capital. Capital increases equity. So does income increase equity. Oh, that's very good. Let me stand in front of the computer, then it'll be straight, hey? Okay, so capital and income both increase equity. They both fall under CLIC. So we will increase capital with a credit. We will increase income with a credit, and the more income and capital we have, the higher owner's equity will be. And obviously, if we had to decrease either of those, they will decrease equity as well. So far, I haven't confused you, right? So up to there, that's all you want to remember. So these last two things are the only things that are allowed to confuse you. What makes equity decrease? We said drawings is the opposite of capital, and expenses, which is the opposite of income. Drawings and any expense, cost of sales, purchases, stationery, salaries and wages. If you don't know your lists, Dead and CLIC doesn't help you. Drawings and expenses both fall under dead. Debit expenses, assets and drawings. The more drawings you have, you will debit. The more your expenses are, you will debit. So if you're buying stationery, you'll debit stationery because there's more stationery. The expense is getting bigger, not your accounting equation. The more expenses you have, the less the owner has in his back pocket. The more the owner takes out of the business, the less there is left in the business that can go to the owner. And obviously, if you have to cancel any of these, it'll have the opposite effect. Does that make sense? So all of them except these two here, only those two are the exception. The others are more is more, more is more, more is more, more is more. But only expenses and drawings, more of a bad thing is negative on the owner. So if you want to look at these accounts like stationery and say, oh, this is just confusing, more is less, then look at it as owner's equity. Owner's equity gets smaller on the debit, bigger on the credit, expenses decrease equity. Drawings is owner's equity, if you like, and it decreases equity. You got the idea? And then the income expenses are easy enough anyway. So you can pick how you would like to remember that. So what we're going to do next is look at how do you put this debits and credits into practice, and we're going to do journal entries. We've done the accounting equation in the previous section. We're now going to look at journal entries.